Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions and form your own financial conclusions and make your own financial decisions. Today is Wednesday, March 8th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL 007, and we are going to start to tackle a little bit of a topic known as futures and options on futures and potentially scalping those. So should be very exciting, and most definitely, I doubt we will cover everything exhaustively as there is so much to unpack there. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, tell us what you're trading. We love to hear about it. We love to also hear the type of content you want to hear about. Also check out thetagang.com/sprocket888, where each and every one of my trades are the good, the bad, and the ugly. Lastly, this is also available as a podcast, so pick it up wherever you get your favorite podcasts. And if you can't find it there, let us know and we will get it there. But let's hop to this week's content, and Viper, it is going to be a lot here. So we are going to tackle futures, options, and potential kind of scalping strategies. And this kind of came up on a chat that you and I were having in the Discord around different strategies you were really hunting for, and you started kind of asking about futures. I think you watched some videos of some people scalping some options futures or things like that. And you dove right in with a lot of questions, and I started trying to answer some of them. And I said, you know, there's a lot to unpack here, because when you jump over into futures, you're bringing, there's a lot of other things that are different. I don't want to sound like it's scary, but there's some basics that we need to cover. And so I kind of broke this episode down. We're going to hit up the S&P futures and what the heck is an S&P future. So futures, there's all kinds of things. There's oil, there's corn, there's soy, there's hogs, indexes, currency, bonds. There's all you know what? It's too confusing to try to cover all of them. Let's just focus on the S&P. I'm going to talk about some specifics there. Then I'm going to kind of jump the next gap into options on those futures. And then you were talking about scalping options and things like that. And I want to jump into Greeks of options a little bit, because those are very important, I feel, if you're trying to scalp, because those Greeks are really what determine the actual price of the option. And when you're scalping, it's exactly what you're trying to do. You're trying to capitalize on the pricing of the movement of the option. So right off there, let's hop into the first one of S&P futures. Okay, so all this stuff is talking about index futures, specifically the S&P. There are futures on multiple indexes, but I really want to zero in on the S&P ones. First difference between this and equities, these things trade nearly 24/5. And what I mean by nearly is they open on Sunday night at 6 p.m. Eastern, 5 p.m. Central Time. So they're all done in Chicago. And they start trading at 6 p.m. Eastern on Sunday night. And they stop trading for the weekend at 5 p.m. Eastern on Friday afternoon. And then every single day, Monday, Tuesday, Wednesday, Thursday, Friday, they stop trading between 5 o'clock p.m. and 6 o'clock p.m. So that's why I say nearly. So they trade 23 hours out of all of those days. They break for settlement and things like that. The other thing about futures that's interesting is futures expire. So it's not like a stock that you can hold forever and ever and ever. A futures contract expires, and there are 4 expirations annually, basically quarterly. Every quarter, the futures contract expires. So you can buy, quarter 1 futures, quarter 2 futures, quarter 3 futures, or quarter 4 futures. Those are the 4 types of main futures contracts that exist out there. And because futures contracts expire, and this is a little nuanced, but what their price represents, this is the futures contract price represents, is it represents where the market thinks that future will be trading at that expiration time. So for example, If I'm buying Q1 futures, the pricing is largely based around what will that price be on March 31st when that quarterly future expires. Now, that is of note because if you looked at Q1 futures, Q2, Q3, you might see that they're not all trading at exactly the same price as the SPY or the SPX in equities. And they'll be close, but they won't be exact. And that is because they're representing the future price of that. Now, the next point to mention about this, and this is probably the one that I find most confusing, and it took me the longest to wrap my brain around. And that is that $1 in futures land doesn't equal $1 in equities land. In futures, they talk about everything in ticks and points. So a point would be a value of 1. So what we would think in equities as $1. A tick is what is the incremental movement between values. And so in some of them, their tick size might be a quarter, which basically means there's 4 ticks to a point. The tick size could be smaller. So in equities, right, the tick size is usually a penny. And then, 100 pennies is $1. So 1 point is $1. In futures world, that's not true. Every product is different, which makes it kind of confusing, and you should need to look this stuff up, and I'll talk about that a little bit later. But there are 2 different S&P products in futures land. There's what's known as the /ES. That is the S&P minis. And 1 point there is worth $50. So for every point that the S&P moves, so if you go from 4,000 on the S&P to 4,001, you will have made $50 because that 1 point is actually worth $50, not $1. The MES stands for micro S&P, so it's a smaller size of the S&P. Tracks the same thing, but is basically 1/10 the size. So in that product, 1 point is $5. So for every tick that it moves, because both of these move in quarter point ticks, the top one moves at $12.50 for every tick. MES moves at $2, $1.25 per tick. And lastly, taxes. So this is one thing that is super nice, in my opinion, about taxes for futures is they are considered a 1256 contract, and those fall under a different tax category. And it doesn't matter if you hold a future for a minute, 10 minutes, 10 hours, 10 days, 10 years. Well, you can't hold it for 10 years because they expire. But no matter the length of time, they are taxed at what's known as 60/40. 60% are taxed at long-term capital gains, no matter how long you held it, and 40% are taxed at short-term capital gains, no matter how long you held it. So a lot of times this is advantageous because long-term capital gains are at a lower tax rate. So when you're trading and scalping in futures, you are basically helping save on your tax bill because 60% of your proceeds are allowed to be taxed at the long-term's capital gain rate, even though you're scalping.
Backing up to the size of contracts, the 1 point is $50. Does that mean if I were to place an order for one ES futures contract, I need to have 200, let's just say the 4,000 4,000 point or price.
Yep.
I would have to have $200,000 in my account or $200,000 of margin available that buying power could be locked up in order to buy that.
Yes and no. So you would be controlling $200,000 of, it's known as notional value. Now, the amount you need in your account is not $200,000 because they will allow you to purchase it on margin. And I'll talk in the next slide of that margin requirement because it's calculated differently than in a regular equity account. And I do want to also mention that the average retail trader, depending on most brokers, do not give you futures account access when you open up an account. There's a few of them out there that do. If you say, oh, I want to trade futures, they'll just add it on. Most all brokerages, you are required to basically ask them to have futures. They don't really have a lot of prerequisites to get it. Really, you have to fill out like a questionnaire that says, oh, I know what I'm doing. Yeah, please give it to me. The next area that I want to kind of touch on here are options on S&P futures. And this kind of tacks right on to that margin question there that Viper asked about. And so to give you this comparison, we're just going to go out in time to April, third week in April. And I've put this down here already. And you can see this is that $200,000 notional value contract. For that expiration, I put a strike of $38.50. So if we wanted to make it truly $200,000, let's put the strike right at $4,000, because that is the $50 times that. And what you'll see here is the amount of buying power and margin needed will be $12,600. This is one area where people love scalping futures because you are effectively playing with $200,000 of notional value in the market. So if you buy one of these contracts and it moves 1%, you are going to profit 1% of $200,000. And that is, but you're only going to have your buying power constricted to this number down here of $12,641. So these futures product stuff is uber leveraged. So, 1% of 200,000 is $2,000. So you're going to tie up $12,000 to make $2,000. That is a ratio that's not possible in equities with the margin requirements. So futures use what's called span margining, SPAN. You can look it up, but it is more of a risk-based margin calculation formula. It's much more advanced than equities. Follows what's known as Reg T or Reg T margin. And that's much more aggressive on how much money you have to put up. So if we switch this over to MES, which is the 1/10 of size, and we go back to that $4,000 strike, just to keep this apples to apples, it's roughly 1/10 of the buying power. So the notional value here would roughly be $20,000. So now let's compare that to equities, and let's go to the SPY. Now, the SPY is running at 1/10 of the S&P. So these things are trading at 385. So I'm going to take this to 400. So that's the same strike as 4,000. Look at this buying power that you need to secure here. Everything here, $1 is a point. So for this $400 strike, you would be buying now 100 of these $400. So you're going to need $9,000 of buying power. The last thing one of the other pieces I need to mention is when we're talking about a put option in futures, one put contract is one futures contract. That's it. One for one. One put represents one futures contract. So that's where we get that 20,000 notional value. One futures contract is 4,000 points. Each point is worth $5, $20,000 of notional value. So you're controlling $20,000 of notional value with a margin of $1,300. Let me compare that to the SPY. So the SPY is in equities. Now, this is a little confusing because here, one put contract in SPY actually represents 100 shares of the SPY ETF. So yes, this is $400 strike, but these are 100 $400 contracts. So this one put contract is representing $40,000 of notional value because it's representative of 100 SPY shares. And you're requiring $9,000 of buying power. So yes, it is double the notional value of MES, but it requires 10x almost of buying power tie-up. And also, these options expire, much like the options that we had looked at everywhere else. They expire now in the S&P futures. You basically have an option that expires every day. You can do Monday expiration, Tuesday, Wednesday, Thursday, Friday. They even have an end of month expiration. And then the last thing to mention here is the options in futures. Some of them are what are known as American options, and some of them are known as European options. And you might think, oh my gosh, what the heck is that? And it's real simple, actually. The way that it is American style options are what everything in the equities world are, and they allow for early exercise. So the options holder with American options has the right to exercise those options at any moment in time that they see fit. So if I have an option and I want to turn it in and exercise it, I can do that at any point in time. European options do not allow for early exercise. So if you're a holder of a European option, you cannot exercise it until it expires. And it just goes whether or not it's in the money or not in the money. You basically don't get a choice. There is no early exercise. For someone who is scalping, this is kind of nice because no matter what you're doing, you don't have a risk of somebody early exercising and you potentially getting early assigned, because a lot of the options and futures are European style. Not all of them, but some of them are. And you might say, oh my gosh, you have given me so much information here. You've covered so much. I'm never going to keep any of this stuff straight. And so the one part that I would pull up here is go to a website called cmegroup.com. These are the people that control the futures market. You can look at every futures product on here. Every futures product is going to have a spec sheet. I've got one pulled up here for the E-mini S&P. You can give the specs on futures, or you can look at the specs on options. You can specify what type of options you're looking at, and all of the detail about what are they traded, what is their code, blah, 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 blah. They also have a strike price listing and procedure table where you can come in here and you can look up all the different types of options. They will tell you their exercise style. Are they American? Are they European? All of this stuff you can look up and check. And this will also tell you the size of them, the strike, like how many ticks are in there. So right here, this one will tell you that the tick size for the S&P are 1250 per point, and they move in, 1250 per tick. So 1 point is $50.
So 1 point is $50. So now in the cost of the option, so obviously we just talked last episode about buying, 35-cent options, $1.50, whatever. So on a futures options contract, we're going to probably more regularly see much larger numbers for the price of that option. So let's say $10. That is actually 10 points. And on the E-mini futures, that's 1 point represents $50. So that's $500 to buy that contract. Is that correct?
That's right, Viper. It's confusing as heck, but that is those things. So every time you have a point on the minis, it is $50. On the micros, it would be $5. And so those strikes that we were pulling up on ES, which would be the minis, I think we're trading around 120 points. So that would be roughly $600 or $6,000 at $50 a point. So it's also really interesting that you have to do those mental gymnastics and math in your brain to see some of that output. And a lot of times I just always look at the P&L chart with the graph because it kind of then helps me do that, because when you jump from futures to futures, they're all different, and points are not the same from oil to indexes to everything. It's crazy.
Yeah. And I mean, possibly, I mean, if you're already confused in what I'm about to say, don't worry about it. But it makes sense the more you crunch on it, like you said, because I mean, in the equities world on a stock, you know, what we just said, what I referenced when we said 35 cents is actually $35. Well, that's because unpack what we're talking about. We're talking about one options contract on a stock. That options contract represents 100 shares. Everything is measured in single dollar. And, you know, the logic kind of flows from that. Obviously, here in the futures world now, one options contract represents one futures contract. So it's 1-to-1. Therefore, now unroll it. What is one futures contract? That futures contract is measured in points. And then, like we just said, 1 point for the E-mini, the ES is $50, and 1 point in the MES micro is $5. So at least in my head, unrolling it like that is now finally clicked. But yeah, I mean, months and months and months ago, Brockett told me about futures many times, several times, and every single time. So, the irony of all of this is he said back then, you need to get into futures. And so here we are, completely, somewhat organically, not by his effort. I stumbled across futures. I said, you know what, there might be something here. Interest is peaked, and all of a sudden, I'm paper trading futures contracts on options on futures. So I made it.
And drinking from the knowledge fire hose, because it's so similar, yet there are so many differences.
So rolling it back, how we got here from my questioning is I'm exploring new strategies, new mechanics, like, I don't remember if it was this episode or the previous episode, but like Sprocket said, there's different trading styles for different people. And so kind of how we got to this point is I've been struggling a bit lately on, interest, enjoying or just, feeling the challenge or something like that. I mean, I guess feeling the challenge isn't quite the right words because it's always a challenge. But just, kind of I guess my role on the show of Mr. Experimental, going all the way back to late 2021 when I started getting into cryptocurrency just to feel it out and see what's going on over there. So kind of came to this point of, started talking with somebody in a different group that I had met online, and he found these scalping strategies, and in particular layering on that different, this idea of supply and demand on price action reading, and then using that when trying to scalp options. Now, this is just all options, just any option. Supply and demand as price action is an interesting take, and I can relate to it. But one thing that I think was causing some of my recent struggles was just the time that I spent in cryptocurrency the last 6, 7, 8 months, as anybody knows or can recall, was dedicated to that space. Money that I had in equities, was just kind of frozen as everything was crashing, purely by chance, not by, awesome plan. But nonetheless, while I was over there, I started to really hone in. And one of the things that I loved about what I was doing in that space was focusing on one or two charts tops. Obviously, we talk about AVAX a lot. AVAX and Bitcoin were the two that I just kind of really started to focus in on. And I would practice, it was like going to the gym where I would practice my price action, my charting and all that kind of stuff. And one thing that I started to notice while I was there was you start to connect to the chart a little bit more. You start to feel the personality of how does this thing move. And not that it's not part of this, but AVAX and, well, first of all, Bitcoin kind of controls everything in cryptocurrency, and then everything moves some derivative amount in relation to whatever Bitcoin does. And I mean, you can kind of relate it to indexes. Bitcoin is like the index of cryptocurrency, even though there is no actual functional linkage like an actual index in the market, but nonetheless, it influences very similarly. And then your underneath, your AVAX, your Ethereum, whatever, moves similarly, but at a larger scale. And so, I mean, we see that in the stock market, right? You see an index. The index is like, oh, a big day on the index, and the market, according to an index, is like, we had a 5% day, and everybody's going nuts. This is huge. And you're like, what? It's 5%. But it's what that represents and what everything did underneath that contributed to that 5%. So bringing it all around, I saw this strategy and I was like, you know what? Let me explore this a little bit more, and let me do it on an index. So the options initially I was looking at options on the SPY, I believe, when I started talking to Sprocket. I was like, let me look. I'm already regularly watching the SPY, so I'm already starting to get a little bit of that chart attachment of the personality of the chart. So I started looking at the options on SPY and trying to plan out this scalping strategy there. And that's when I told Sprocket, I was like, so it looks like I'm going to do one scalp per day, because part of dribbling my account back in, I do not have pattern day trade status. And so scalping, that's kind of something important to have or pay attention to. And so I can open and close a trade once in a day, and if I do it again, I get a slap on the wrist. And then if I do it too many times, things tighten up and I go into detention. So I told Sprocket, I was like, so I think I guess I'll just do one trade a day. And that's when Sprocket reminded me, futures, man, pattern day trade doesn't apply to futures. And as he said, the pricing of the MES is similar. And you get the extended hours. So if I've already formulated a strategy that I'm testing out on paper trading for market hours, and then I'm going to start observing after hours and see what that feels like. I can already clearly see these are two very different personalities of the MES, is during market hours and after market hours. But then I have a little more flexibility of something that I'm used to in the world of crypto, where I can, after work or in the evenings or whatever, kind of sit down and scope out a play. So that all made sense, and that I started digging into that, and we'll see where that goes.
Yeah. So when you're dealing after hours, you're talking about different price reactions and things like that. I encourage you to look into when China market opens and when the European market opens. And I think you'll get two other different flavors of how futures trade. So I think it's around 11 p.m. China market opens. And so you get a lot of activity in futures around that time. And then I think it's around 3 a.m. That the European markets open. And then you get additional activity and price movement around that point.
Yeah, that'll be interesting for sure, because I did notice today, I did a first little test the waters scalp last night, probably around that 11 o'clock time. It wasn't dramatic movement or anything like that. And then this morning, I popped on before work, and so it was like 8:30. I don't remember. Um, but or no, it was like 9:15 or something when I was on, and so I was looking. I was setting up. I was looking at a potential play, and I was like, oh, let me charted it out. And then 9:30 hit, and all of a sudden it was like, oop, doop, 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 and now and so that made it clear uh, to be very attentive to that market open, and that's a good point about other markets opening and kind of being aware when that happens. Because uh, luckily I was in the paper account, but I had set up a trade at like 9:25, completely forgetting the market was about to open. And all of a sudden it moved against me real fast, and I was like, what the heck is happening? Oh, the market opened.
Yeah. So kind of speaking to your scalping strategy, I mean, the first thing I'd just bring up as a suggestion is, have you considered just scalping raw futures instead of options on futures?
Okay. Um, so at least initially, no. Um, the and I think some of that is, well, first of all, I just hadn't thought about it. It feels, I guess I'm trying to play through in my head if it actually is true. It feels more risky for some reason. Um, I don't think it actually is, but what's going through my head is so the scalping strategy that I've been practicing today is literally buying a call or a put, which first of all, at least currently appeals to my risk mitigation part of my brain. So the contracts I did today, I was doing them in batches of 10, but that's just because that was the default order. So doing some quick math in my head, it was like putting up $50. I mean, it was usually 500 to 700, but again, it was in tens. So it was putting up $50 to buy a contract, an options contract. And so it goes back to our, anytime we talk about contracts of like now immediately, I have my risk defined. $50 is on the table. I will never lose more than that $50 that's on the table. And then so the scalping strategy is then now I want to sell that back at a higher price. I go ahead and grab that difference as well as my $50 back, and we're off and out of here. So that's the theory behind it. I feel like trading the futures directly, that I would have more exposure to risk. No, or I mean, I guess stop losses.
Stop losses would be how you would control that, just like when you were in your 1% trades. And I'm like, you're kind of cheating a little bit because you're taking on a huge position, but your stop loss was cutting your risk mitigation. The reason I bring that up, and this will kind of transition to the next thing I kind of want to call out, is futures are already leveraged. That's that whole 50 points, $50 per point or $5 per point leverage that we already talked about. The buying power is calculated on span margin, which amps up your leverage even more. And you're calling out moves based on price action of the index, which is great. Okay, you're focusing around the price action of that. The thing I want to call out is the price action on the index is not a linear translation to the profitability or loss in the options world. What I mean by that is the pricing of the option. This is not true. This is not only true in futures, it's true in equities too. The option pricing model takes into account these things called Greeks, theta, delta, gamma, vega, rho, and these are inputs to the price of the option. So it's not just basically a linear translation of the price movement on the underlying. The actual price of the option is influenced by these Greeks. And that's kind of where I was going to take next here, is talk about some very important Greeks to look at depending on when you're touching options. Are you touching near dated options like close to 0 day, week of expiration, or are we talking options that are 3 weeks, 4 weeks, 5 weeks out?
Yeah. So let me potentially nuke the whole thing.
Okay.
What I mean by that is let me throw down for you exactly what I'm testing out as far as the scalping strategy. Now this is very specific, very focused, but I think it at least kind of maybe addresses some of that price action and price not being linear to the options price. But before we jump in, I want to just like flashing red light to anybody watching. Like, this is so experimental. This is why I'm in a paper trading account. We talk about paper trading all the time. No, I'm not in the paper trading account because I'm worried about my emotions or anything like that. I already know. Like, this is, I think, a really cool use of the paper trading account because of everything Sprocket just said. I have a thesis for this strategy. There's a lot of flipping variables that are around this, and it's the perfect place to feel that out and watch those unfold and use the paper trading account to not accidentally be like, oops, I should have thought of this, and now I'm out X amount of money or anything. And there's well, all right. So let's jump in and just hop to my screen here for a second. Part of this, how experimental this is, let me clear some of this out and make that a little bit bigger. This is involving some price action, chart reading, but there's, like I said, so I mentioned supply and demand earlier, and this is an entirely new concept to me. It's not a new concept to the world of technical analysis and price action, but it's particularly important, especially as we're talking about price action and price movement and options movement. So what I did on this chart is this blue line, the vertical line on the left was actually the market open. And then on the right, let me square it up here. On the right, we have the market closed. So this is important because I really want to hone in on just market hours because, again, that talk of different personalities and whatnot. So at least the concept of supply and demand zones are and I mean, this applies to other stocks, but I think it's especially interesting on an index because of the size of the volume that the index represents. And so obviously the idea is that when you get up towards the top here, that this is a supply zone where then sellers start offloading. When you get down towards the bottom, this is a demand zone where buyers start buying. And the idea is catching price movement between them. I'm pretty sure today was just a picture perfect day for this. And that's because look at how sideways we were today. We came in here 39.63. We left 39.57, 58, something like that. So we had a very sideways day. I do not expect this to be this picture perfect on a more volatile day. But this is factoring into my thesis a little bit. On a more volatile day, maybe there's not a play. Maybe I just skip that day and I look for this. So, but basically what I did today was knowing that I wanted to set up these supply and demand zones. I wanted them to be discovered. I wanted the chart to show them, before I made any decisions on anything. So, like I said, I did a little scalp this morning before the market opened, but it wasn't really, it was actually based more on what I think applies to what you were saying about price not being linear to the options price. I did it more on a really, really direct price action scalp, like this little swing up and down. And so it was coming down on the 1 minute chart or whatever. It was looking like it was going to go down more and it popped, that sort of thing. So super zoomed in. And I don't think that's a great place to be for everything you just said. So I let the market open. I let the price discover. I went about my day job. And then coming up around lunchtime here, I was like, let me just pop in and let's see what's set up here. And it just so happened that there was a really this first two waves here set up a very clear. Again, I can't say textbook supply and demand zone if I'm just learning about this stuff, but what appears to be like a textbook supply and demand zone, where you take this one here, we draw this rectangle from this candle to this next peak, and I extended it out, then did the same thing on the bottom. So, lunchtime here, I was like, you know what? This is actually looking, based purely on how these two zones are most probable to interact with each other. We actually had this little pop up and then come back down. And so I was like, you know what? I really like that move that it just did. So right around here, I bought, it was like the 39.70, I believe. Yeah, it was the 39.60 put. Bought it here, and I was like, let's just see what happens. And so it dibbled around, and then sure enough, we came down to the demand zone, and I closed it out down here later on in the day, 2 o'clock, 3 o'clock. And that was a $200 profit on that move. So the price move mattered. I see what you're saying about the price move not being linear to the options price. But one thing that I want to keep feeling out here is there's got to be a limit to that. If the price move is big enough, then the price move can take over some of that effect on the options price. And so I feel like it's at risk of what you said if it's more of like a traditional scalping a stock, at least just based on little smaller moves. But I also did this entire thing without paying attention to theta, but not knowing what the numbers I was looking at represented. I know the concept of theta. And so I was also choosing strikes that were 3 or 4 out. So coincidentally, I might have been doing a really good thing in terms of gamma, because I was going a few strikes out where that gamma bell curve is kind of coming off. And so then as it moved into my zone, that $200 might have been kind of lucked into because I just happened to catch the gamma pump as we came down into that range. So saying these things out loud, because this is why I'm paper trading this, because this is a lot of observations and repeat experimentation that needs to happen, observing those Greeks and making sure that there's something here and that this just wasn't a beautiful day to stumble into this.
Yeah, no, your explanation is actually helpful, because what I view what you're trying to do is you're using the options to basically synthetically trade the shares because you can get them at a lower price. That's why a lot of people use options in equities world too, is because your capital usage is much lower, but you can still then, can't play with the price movement and things like that. And I think for the use case you called out there, you definitely want to be trading options over 35 days to expiration. So you're maybe 40, 45 days, maybe even 50 to expiration of those options to capture that price movement stuff. And the reason for that, and it sounds like you experienced this, but you didn't know it, was the Greeks that are going to influence that price are heavily muted when you're that far out. They're there, but the amount that those Greeks change in hours, days, even at that point, is very, very small. And so largely the only Greek you're really dealing with at that distance from today and at the length of time you're holding it is delta. And delta really is just directional risk. It's just a way of saying, if you have a 50 delta, that's the equivalent of half of a position. Like half of you it's a 50-50 risk. It's a $1 movement is a 50-cent movement in price. It's purely the price movement. So I think it's important that to accomplish what you did. Now, if you tried to do exactly what you did here on week of expiration options, I speculate that your result, you still would have won, but your result could have been more amplified, or something to that effect. In this case, because you're longing the put, it likely would have been bigger. So if you picked up a $200 gain on, let's say, a $50, say you paid $50 for those options, right? You 4x'd your money. If you'd have done that on a week of expiration, your likelihood of hitting that 4x might have gone down. But if you'd have hit that same movement, you might have 8x'd your $50.
Okay, so you're saying the further out, obviously the Greeks are heavily muted. The let's just call it profit potential is lower because it's a heavier thing moving around that far out.
It's not that the profit is lower. It's the profit will be more linear, and the profit will not be hampered by any Greek interference, except for delta, which is just directional risk, which is exactly what you're trading.
Okay. Okay. That's interesting. I mean, and that's certainly the best next experiment, because this was done today on tomorrow's expiration. So this was 1 DTE. And so now I have a feel for that. So it makes sense. The next experiment would be to now hopefully catch a day like today, or at least know that or at least catch a move of significant price move like today, because obviously you want to keep as many factors similar as possible, but then now do that on, like what you said, 30, 45 days out, and kind of see how that feels.
Sorry, when you said you were strikes out, I assumed you were going strikes out and expiration.
Oh no, I meant on the chain, on the options chain.
Oh, okay. So if you're dealing already with low DTE on this scalp, the reason your scalp was of that level is likely because you got some great assistance from the Greeks.
Okay. That makes sense, especially in terms, it sounds like gamma especially, where if I had bought that in the gamma bell curve, if I had bought that unknowingly much higher on that bell, there's so much elevated price already influenced into that from gamma. So like I mentioned, it's quite possible that I just happened to pick a strike far enough out where I was kind of out of that bell curve, and the reason it hit the way it did was we went into that bell curve, gamma influenced, and on the volatility of price coming down, gamma, did its thing and pulled that up.
Yeah, let's just look real quickly here at some charts that I have that kind of explain this a little bit. And so this is a little bit about gamma and theta. The top two charts are about theta. The bottom two charts are about gamma. The left side is with respect to time, and the right side is with respect to volatility. And so the first, let's talk through theta just a little bit up here. So this upper left chart, which is theta with respect to time. The one thing that I want to call out is there's a theta premium in every option. And the more time, the more theta. And the more extra, fluff gets priced into the option. What happens as you near expiration, for strikes that are close to the money, this red line, is where it hits zero, that's expiration. And that theta will fall off very quickly when you get close to expiration. It doesn't move much when you're far out from expiration. So that's what I'm saying. You can mute theta, because when you're far away, if you're buying and selling in the same day, the amount of theta decay is pennies. Like it's trivial, right? When you're looking at the theta decay in 1 day, 2 days away, it's substantial. And so when you're going farther out, who cares what theta is? Yes, you bought it, so you paid for it, but you're selling it right back same day. So you're going to get back your theta. So that's why it's kind of a null factor in this. Your volatility of theta the more volatile, the more theta it is. So this really is about premium selling. You're trying to long from here. So volatility doesn't matter because, again, you're buying and selling the theta. You're buying it, then you're selling it right back. So, okay, yes, if volatility went up, okay, maybe you squeeze out some more, but we're talking, how much does volatility change in a day, in a time period? So I think that's really negligible. Now, the part where you likely experience, this is the bell curve you're referencing. Let's jump down to gamma, which are the bottom two charts. In the one on the left, there's 3 different bell curves, and these are this is strike prices on the bottom, and gamma value is the vertical. So the blue one is, really far out, maybe 30 days, something like that. The red one is, maybe a week or 2 out. And then the green one is like week of. And this is the extra value that's going into the option price, known as gamma. Gamma is the rate at which delta changes. When you get close to expiration, the closer you get to the strike price, the bigger and bigger and bigger gamma gets. So it stretches up. And so if you're purchasing an option out here to the left of this bell curve, where there's not much gamma, if you get price movement and now the underlying comes into your strike, or basically the money comes, your strike becomes closer to the money, your input from gamma goes way up. And this is where you will take, a 2x and maybe make it a 3, 4, 5, 6x if you happen to buy the gamma when it's low and price movement brings the gamma in. So in your example, if you bought a put that was far out of the money when you did, which is what it sounds like happened, as that strike or as that underlying comes down to that put price of what, 39.50 or whatever you called it, if that's where your strike was, now that strike is in the money or close to the money, and that gamma is a huge value. So you bought the gamma when it was negligible because that strike was far out of that bell curve. Then your price movement moved that bell curve in. And this gamma is the rate at which delta changes. And so this is your X multiplier on your profit because it's close to expiration. If you were dealing with something far away, it's more of a little bump, speed bump or something like that, right? So it's more muted. And that's why I said, you're not, when you deal with those options farther away, it's a more pure directional trade. The Greeks don't get in the way. But when you're in this close to DTE expiration, you have to be cognizant of this because, one, you can use it to amplify your gains. Buy them when the Greeks are low because you're paying for the Greeks, and sell them when the Greeks are high. And that will just kind of amplify your stuff versus far out options. Okay, there's not much movement from here to here, in or out of the money. So you're kind of muting because you're buying and selling.
That makes sense. And yeah, like I said, to me, that's why I'm kind of excited about exploring this in the paper trading account. Because, I mean, obviously we've talked about the Greeks for a while. And I've never had a use case where I was like, oh, I really need to pay attention other than delta and theta. But even before, when I paid attention to theta, it was just the concept of theta and the idea of that top of that chart where you saw the theta drop and then hit hard. So all I had to understand before was just the concept of that curve, know where I'm at on that curve, and just be mindful of it. But in this case, like you said, if I'm doing something close to expiration, it's paramount to pay attention and watch those things. Or, like I said, next experiment will be interesting to go way further out where those things just aren't even a factor. Let's see what it looks like as far as ROI and P&L out there. And that's what I'm working on, I guess.
Yeah, let's visualize this just to make this a little more concrete here. So we talked theoretical there with some of the charts. Let's switch over. This is Thinkorswim on the option chain. And one thing I want to call you out is when you're looking at the option chain, you can change the columns that you see. And so I tailored this one here, and it includes, you can see there, theta, gamma, and delta. This is something your brokerage will have on your indicators, and this will let you see the individual components. So let's start with, I said, hey, let's go 51 days out or 50 days out, something like that. So let's go to April expiration. These are 51 days to expiration. And let's come down here close to where we are at the money right now. And gamma is this column here. It's a 0.0015 is the gamma at 40.20. Okay. Now let's just go out 100 points on this. So we'll come down here to 39.20. Gamma has gone from 0.0015 to 0.0013. First of all, gamma is not very high. Second of all, we went 100 points on the chart there, and we only decreased from 0.0015 to 0.0013. Now, let's take the other side of this and let's go much closer to expiration. Let's go to tomorrow. So this is the other extreme. This is something that's real close to tomorrow. So let's come down here again. And we'll start here we'll go 39.40. Look at gamma. It is almost 8x what it was before. So we got 0.01 is the gamma at the 39.40. Again, let's go out 100 points here from 39.40. Let's go to 38.40. So 38.40, gamma is 0.0008. This is exactly that thing that I'm talking about. That gamma is stretching super, super tall right there at the money at 0.01, going out just 100. Well, 100 points is in eternity, right? That's super far away. But we went out 100 points in both, and you saw how little gamma changed. One, gamma was low to begin with. Two, how much did gamma change across that spectrum of ticks? Very little. Here we're expiring tomorrow. Your gamma goes from 0.01, same distance over those, down to 0.008. And that is really just something where it's understand the mechanics of what you're trading. Do you need to understand them? No, you can trade on anything, right? But once you understand how this machine is working under there, you then can start to bend it and shape it to your strategy. And so, Viper, you said, oh, well, the only thing I ever knew about was this theta decay. Well, you know why that's the only thing you really knew about? Because the strategy that you were learning at that time was premium selling. And that's the only thing that matters in that thing. There is no... I might have mentioned the gamma thing to you because I think I always said, hey, you need to get rid of this thing at 21 days to expiration or 14 days to expiration because you're going to come into a thing called gamma risk. And This is the gamma risk. But gamma is not a risk if that is your trading basis, right? And that's what I love about options is understand how they're priced and how they're worked, and then go after the piece that excites you or fits your strategy, right? So for premium selling, these same day, week of expirations, this is not something you monkey around with on premium selling for that slow burn theta decay, which is why you were never exposed to this, because on that strategy, it's sell them when they're getting ready to take that nosedive down, hold on for the ride down, cap them at 50% profit, move on to the next one.
Yeah. And I definitely want to call out that statement of understanding what you're selling. Because I can already feel like, I mean, we don't talk a lot about strategies around buying options. And I mean, a lot of it's because, the only thing I knew about options was whatever you best explained, which was obviously whatever fits your style, fits your objectives and whatnot. So obviously that's a lot of premium selling and things like that. I can already see very clearly, and I mean, I imagine anybody that just watched and heard those numbers can see how this could become a very dangerous, risky type of thing, even though that was predefined as like $50. It's very easy to see how this could be. Well, that $50, and I missed that one. That one went to nothing, and I lost that $50. Let's roll it again, $50 more, and like all of a sudden we're in the casino, and that's where I think it's important to step back and acknowledge the sharpness of the knife, but the intentionality of understanding why it's doing what it's doing, how it's doing it, and being smart about it. In that, having like the play I described, I just stumbled into success on it. Anybody could, but then they start throwing those bills on the table of like, it worked that one time, I'm going to do it again. And like I just acknowledged, it might have worked because of that gamma effect. And, that could be the strategy, is strike that gamma effect. But I stumbled into it. I didn't look for it. And so that's a pretty key distinction of what I want to get out of this exercise in paper trading. I do intend to take this into real trading, but I want to understand that machine so I can have the approach and the strategy to know what needs to tweak on what I'm watching if I start to find that I'm throwing more bills down and getting more losses than winners. And then that goes back to all the fundamentals of all strategies that we
Yep. I think that's the key takeaway that I would emphasize everybody gets out of this is no matter what you're trading, no matter what your strategy is, understand the nuts, the bolts, the ins, the outs, the left, the right. How does the machine tick? What makes it whir? What makes it go? What makes it stop? Because understanding that is the key to unlocking how do you really take advantage of it. That brings us to the end of this week's episode. And if you're still with us, I guess kudos to you, because I am sure if you are a newer viewer or something like that, we lost you forever ago because you were probably like, holy crap, that's a whole lot of things. I'm not ready for that. I just want to know, how do you buy Facebook? But to those that have unlocked the next level of awesome and are still with us, this is exactly why I put this stuff out there, why I started this channel, why I write this, is because I think fundamentally knowledge is power, and understanding things and really questioning them and looking into them and the mechanics of them are really, really where knowledge is gained and unlocked. When you start to question, think that, and go that. It's kind of equating to learning anything. Can anybody get inside a car and drive to the grocery store? Yeah, probably most adults can. Probably even some children can do it better than adults. But could we all get in the Daytona 500 and finish without getting lapped? No. And that's this skill of there's nothing really special about those particular drivers aside from the fact that they spent time learning the ins and outs of the track, learning the ins and outs of their car, learning how to dial this in, dial that in. It's not just, oh, I hopped in the family sedan and I made it to the Kroger. It's just about how far down do you want to dive into that? Go as deep or as shallow as you want to get your objectives. But the more that you know and the more that you understand, the better and more accurate and stuff that you can apply this knowledge practically to trading vehicles and things of that nature. So I guess the takeaway from this episode is question it. Whatever interests you, start digging in, and experiment, paper trade, learn, ask questions, go find somebody, go find articles, go find channels, empower yourself with that knowledge. Aside from that, 1% trades, I got to get back in the saddle on those. I think we've kind of strayed away from them now for about 2 weeks. So I got to pick one out, got to get into another one. Viper, I'm expecting your next 1% trade to be some of these scalps in this world now. You're committed, man, at least for a trade or two.
Yeah. Yeah. I'm gonna have to figure out how to bet, like, like an average of them throughout the week or something. Yeah, we'll see how often they pop up and how long they take.
Yep. So I'll be out there looking, end of the quarter coming out, lots of news and uncertainty in the markets. As always, I feel like I say that every week, but, the markets are uncertain. So hope you guys are grabbing nuggets of information, having fun trading out there, getting a couple of winners. And remember, think outside the block.